Hello, ladies and gentlemen, and welcome back. Well, it doesn't get much bigger than this in the markets around the world. We're about to find out whether the Fed potentially has pivoted in their strategy to combat inflation. The stock market has, of course, been betting on this over the recent weeks, and everyone is starting to FOMO out of control. But wait, the 200 SMA is now here, and the bears are trying to defend this trend line. We've seen so many key points being reached over the last 24 hours, including big Fibonacci zones, a movement above the previous swing of 4,300, and of course the chance that this is all a false breakout. Stay tuned as we uncover not only what retail traders are doing right now versus the smart money, but on top of that, some massive stats around this rally so far. This is going to be a good one. We'll see you very soon. So welcome back, everybody, to the Daily Show, where we talk about markets around the world, including stocks, commodities, and cryptos. If you like anything to do with markets, why not consider subscribing? And of course, smash the like button if you find value in today's video. Let's get started. Fear versus greed. Of course, Buffett's famous quote about fearful and greediness. Where are we right now? Extreme greed, guys. We've just topped above the 90 zone. Now, this has usually meant lackluster returns were coming over the next coming weeks. Notice the reading here, probably the most important one. Coming off the 2020 boom, we got a very strong reading here, 90 plus on the greed index, and then we saw a drop off. Now, was it significant? Well, it was still 7 to 8%. It's something that's worth noting. Now, we've got so much information in today's video, but one thing I want to bring up was something we shared on our Twitter. Come follow us at FX Evolution on Twitter. Make sure to join our public Discord or private Discord as well. Plenty of great information in there. But here it is. Relief rallies during bear markets last on average 37 trading sessions. I think we're around 39 to 40 right now. It's also worth noting that most of these particular rallies in general lasted between 8 and 14%. On top of that, we always saw them go to a very interesting point. There is a strong correlation between the size of the decline and the ensuing rally relief. The gradient of this trend line is 0.677. We'll look at that on the charts later so you can see where that was, because it's right around where we are right now. Should the rally go to about 67.7% of the size of the preceding decline, that was usually around the point that many of them fizzled out. Well, guess what? We're there, and we're ahead right now into, of course, the not only retail sales coming out of the US, but also the big information about the FOMC statement. The Fed's coming out, and they're going to come and tell us whether they've potentially pivoted, maybe some information about what they might be doing in the future to do with yields. Such an important moment in the stock market. What about smart money versus dumb money? Many of you requested this. Not any changes here, really. Dumb money continues to technically be buying this dip at these levels. Smart money has dropped their purchasing off. They obviously were purchasing heavily, as we really reported down the bottoms, but it's an interesting point nonetheless, and it really ties in well with that greed versus fear. So let's have a look here of the number of trading days for rallies, and we'll specifically be focused on the tech sector. And the reason why is the tech sector tends to be the best buy should we be rallying, and that's usually the one that comes up. So what about the percentage of tech sector rallies from over 20% of the 52-week lows? How long has it taken? It took a median of 21 trading days generally for the tech rally off a 20% low. Interesting. What does that mean? Well, we're just reaching that point now. We've obviously gone over 20% rally from the low. You can see it here. We've now put that and printed it in time. And these are all the other dot plots going all the way back to the 1930s. And you can see some of them were good, some of them were bad. But in general, 1 and 2 weeks later, look at these stats. 33% of the time, once we got this reading, the market was higher the next week. That's not that great. Neither is the 2 weeks. But as you go out further, it kind of points to obviously a very strong stat moving into the 1 year and even not too bad into the 2 months. So if it's going to drop, it kind of needs to do so in the next couple of months. Here's a bit of a dot plot between quicker rallies and, of course, future drawdowns. We've just had around 40-ish days. So if you think about it, we're rarely around here in terms of the dot plot scatters. Yes, one was bad, but most of them were a lot less than you may think. Not many of them went past like that 15%. So the faster a rally happens, similar to the rally we saw in March of 2022, the more likely it is to be a more brutal drawdown. It makes sense, yeah. It's like a dead cat bounce, as many people call it in technical analysis. Another thing that's a bit problematic at the moment, and probably the biggest issue, as you saw the meme at the start of today's video, is that retail traders are not convinced by this rally. I usually prefer it when retail traders make the mistake of going against it. Of course, us here in the community, we want to be doing the right thing. But in general, if lots of retail traders are opening puts, the market tends not to go down. Now, Michael Burry's losing his mind. He seems to be the one that has really got a lot of puts somewhere down below, but people are just stacking puts, whether it's Wall Street, whether it's retail. A big part of this rally is probably due to that and needing of expiration. Notice we got a similar reading over here in 2020. The market went up, obviously the fear greed index. We got that pullback of around 7 to 8%, and that was actually it. It just continued to go up while everyone else remained incredibly bearish. Continue watching this channel because we'll update you on these put call ratios moving forward. We are watching, of course, China and the active cases of COVID. The reason why is because lockdowns may hurt supply. That could also therefore bump up something like, of course, the yields in the future. That's going to be important. It happened in March. Will it happen again? We've just seen another uptick in cases. Something to watch. Obviously, the policy over there is to lock cities down. So if we get Shenzhen, Shanghai, or Beijing locked down, people aren't talking about it. I'm going to bring it up because I think it's a real threat to the markets in many ways. Corporate insider buy-sell ratio, we won't talk about this anymore. Obviously, we got the reading a few days ago here. It's a bit of an old news. But I just wanted to point out that when corporates are buying, if you're an investor, it's a different strategy to a trader. And usually the corporates are correct. In fact, 3 months later, the market's always been higher. Big stats there, by the way. And 1 year later, again, 100% of the time, they've been correct. Corporate insiders don't buy for no reason. They see the under the hood earnings and they like it. So you've got to pay attention to that. Volatility traders, you guys should rejoice. We're coming into mid-term election season, August, September, October. We're now at, of course, a 20 VIX, which we'll be looking at soon. It's a big zone and expect volatility moving forward. At least that's what the stats say. We know we're at a pivotal time. We either drop pretty much right where we are right now, or we move into a rally that people can't really understand. Most of you hope for this case scenario. Some of you, of course, will be going, hell no, I want this thing to go up, Tom. I want to recoup my potential losses. On top of that, I want to go to the moon. And I totally get it. So for both ways, of course, we'll be open to both concepts. We have to be. That's a trader's mindset. Investors even, you're always looking for the next opportunity. September is the worst month of the year. We're getting closer and closer to that month. Of course, in midterm years, September tends to be a horror. Then October, November, and December tend to be better. Will it be the same? Stats would say yes. I do have 200 years of stats. I'll bring that up in another video. But today we'll focus on bonds versus the stock market. We've got so much to cover. Q2 earnings gets worse. 60% beat rate. Was 61, now is 60. 2,241 beats. Misses 1,464. So it's not really a fundamentally driven market right now, that's for sure. It looks pretty horrid on the surface. Here's some of the earnings coming out later on this week if you're interested in the earnings season still. And of course, we need to look at the sectors doing best in the last 24 hours. Most notable, XLP, consumer staples, guys. This is the one that most of the time we see being stacked before, of course, potential drop-offs. This is day 2 now that we've seen defensive sectors do a little bit better than the rest of the market. It wasn't that strong for defensive sectors. It started better for them, but still, staples, the best sector of the day, something worth noting and thinking about. So it's time for us, before we get into the charts, to speak about today's sponsor of the video, which is Tiger Brokers. Guys, I've got a really cool feature that they've introduced into their platform. Come over here to the financial side and click on more for any one of your stocks, whether it's an Australian stock, whether it's an American stock, and it will load up so much data that your mind probably will be blown. The great thing about this is we can see cash flow statements, we can see net income, we can compare these things with each other and others in the industry. You'll notice here, of course, I have Tesla versus the other ones. There's just so much that you can do in this. Obviously, if you want to get filings, you can get all the filings over here. If you want to know more about the valuations, you can get the valuations here. You can look at the PE ratios, the EPS, all of the different ones in one window, and of course, load that over time. This is something that I think is missing in a lot of brokers. They don't have the in-depth data. Great thing about Tiger Brokers, they're always improving and taking on feedback. I give them feedback as well, don't worry. I listen to your comments. It's amazing. It really does help, and it creates a better platform for retail investors to use out there. If you want to know also about things to do with the balance sheet, you want to know how much cash they're holding on hand, who's actually holding this thing. We scroll down here. We can see Elon Musk holdings 155 million shares, but he's been a sneaky one. Look at this, negative 22.61 million. Now, we all know that, but the most important thing is you can see it in the platform. So if you're interested in Tiger Brokers and everything that they offer, jump down in the description down below. There's a whole bunch of special offers for every one of you, hopefully in the community all around the world. All right, guys, let's get into the big stuff here, the charts. And we'll start off here with the VIX, the volatility index ahead of the big FOMC statement and core retail sales, the same place as it was before the February volatility, the same place as it was before the April volatility. We're at the 20. We know this is where bulls and bears make it. Basically, we exit bear markets generally when we get underneath 20, and we enter bear markets when we're above the 20. So we're at point critical. What else is critical? Well, it looks like yields. Now, we're still rallying here, but I can tell you core inflation and all of these supposedly hitting the top of inflation and everything didn't do much to yields. The 2-year remains elevated at 3.268. It's getting ready to find out what the Fed is doing. What an important 24 hours this will be. TLT also doing pretty well. This is obviously more to do with the longer term yields. If you are a believer that the US market or the US economy in general is a little bit sick, then over the longer term, there is a real chance here in TLT. If the US 10-year yield goes down, of course, what happens? Usually you get an increase in the longer dated treasury bonds. And a lot of people like this trade. Obviously, it looks like a inverse head and shoulders. It's slower. It's there. We've been talking about it for a little while. And obviously, there is real potential here. Remember, come from the abundance mindset. If you miss the stock market, there are other opportunities in other markets or other stocks or anything like that. There's always another opportunity somewhere around. Let's move over here to the dollar index. And before we jump down to the 15-minute, I just want to take a look at the daily. Little rejection candle here on the daily over the top of hitting that resistance. Let's go down to the 15-minute now and understand what's actually going on. It's putting a fair bit of pressure on. So what that means is that the market has kind of gone up, consolidated up, breached that consolidation, and now is potentially either accumulating or distributing. We don't know yet. If it busts down quickly and then comes back up and takes out the 106.60, I'd be actually pretty bullish on the US dollar at that point. It's kind of like a false break to the downside, and I'd be looking for further action up near the high 107s. If it does, however, just kind of sit around here, maybe come back a little bit, doesn't make a new low, keeps coming back and then starts selling off and makes a new low, get ready for at least 106, or if even like a 105.80. The US dollar is at pivotal. It's at a critical zone. No surprises here. It's going to be really fundamentally driven by core retail sales and the FOMC statement. Whatever happens there is going to move this one. Similar on gold. Unfortunately, it's at a kind of critical zone here. I am bearish on gold down to the 1755. You guys know that if I'm talking about the next month to 2 months, of course, I am bullish on gold. I've seen the money flow. I've seen enough from me anyway to think that these guys are getting into this particular asset class. Remember, gold is pretty bad 95% of the time, but around 4% of the time it's fairly tradable, and 1% of the time it gets pretty damn good. And maybe we're entering into a fairly decent time for it. So we do expect some weakness here. For you to be bullish again on gold, you're going to want to see it break past like a 1786.50 from a technical zone. That will just really clean all of these previous support levels. It will take out this little high in the orders, and then we look for a pull towards the move up. But from the action over the next 24 hours, there is also a real chance it gets back down to the defended area, 1755. If it does, what do we expect to come in here? Most likely buyers. So be careful here, guys. This is not really the greatest exact zone here for gold. You need triggers each way. At least that's my opinion. And right now, if I was guessing, it would be more towards the bearish side than the bullish side based on the current price action that we've seen. Speaking of bearish, oil fell through. So theoretically good for stock market bulls. Oil really is having a bad problem. And I've said this for months now. I absolutely hate oil at the moment, and I have no bullish intentions over the long term because I do think that oil will eventually stabilize and move down into the 65. I'm not the one that goes $300 oil, could be wrong, but inflation really would have to be getting super out of control, and I don't think it's going to get much worse than where it is right now. Now, where is oil though? Is there a small pullback potentially coming? Well, we're entering into, of course, from the top, a decent fib pullback. This is the 61.8 to a 66 fib pullback. We've also got the weekly high sitting behind over here. So if we come down to this zone, again, a critical area, and then we do bust up, will I potentially get bullish on oil? Well, I would probably need to see it go past 95 and then look towards a little bit of bullish side for now. And to get more bearish on it, I'd want it to break underneath 84 and then, of course, look to sell the rips down into either this level here, which would be the price of around 75.50, or of course down into my eventual plan, which is 64.50. I don't think it gets there within a month or anything. This is going to be a long term, 3 month, 6 month, 12-month plan to get down to those levels. But oil at a critical point, no surprises ahead of news. Tesla, where is it? Resistance ahead of news. Now, be careful here on Tesla. There's real chances of a whole bunch of different things playing out over the next 24 hours. There's the chance that it goes past 960 quickly and then dips down. Be careful of that. That's what we call like a swing failure, effectively taking out the orders that are stop loss behind here and then quickly reversing from that. If we manage to close above it though, the real chance here is 1,050 for Tesla traders. If you want to wait for more information, then of course have the patience to see what the stock market does, and we'll look at that in just a few moments, and you'll see that maybe that could activate this trade. Apple, long leg doji ahead of course, the news coming out. Massive ramp here on Apple, very strong stock. It's hit lots of different trend lines. This is basically the last one you could have drawn if you were going to draw it. We talked about trend lines in the previous video. The long leg doji shows indecision or equilibrium ahead of the market decision. So of course, it's waiting to see what the market brings. We'll be watching that. Now, what are some of the good points for the bears? Well, of course, the worst point out there is too many retail traders are bearish and they keep opening puts, and it's kind of annoying. We'll see that when we look at the options. But the good case is that hype stocks are going wild again. We've seen this Triple B, Y, Bed Bath & Beyond going wild. Kramer's fighting with Wall Street bets on this one, and a whole bunch of things happening. Of course, this was similar action to what we saw happening in March and April before, of course, the market tanked itself. Be careful in a stock like this. Look, it's not my jam. I understand there's a lot of money to be made if you get on it on the right thing, but you've got to know when to get out. Did it just hit resistance? Well, it seems to have, and that was certainly a key level. But as we know, anything is possible in these stocks. We're looking at it just to show us a bit of the idea of people getting, I guess you would say, a bit silly with their money, getting really intense, basically gambling a little bit on the markets. That's what it is. Let's call a spade a spade. DAX 40, trend line ahead of news. Nothing else to say about that. It's hit the trend line. We know where we're at. Big important zone here over the next 24 hours. IWM, Russell 2000 versus S&P 500. What's it doing? Well, of course, it's at a zone where we were critically before we entered really the true real bull market. That happened back of 2020. That's when people all got convinced. Everyone was convinced it was all good. We're green, we're good. This is an important ratio. Have this on your charts. Look at it. It's going to be a big one. And you would expect small caps to outperform the big caps at that point. What about bonds, though? Are they doing well? Well, we know that during, of course, previous sell-offs and rallies, bonds usually come with the market during that time. So if we go over here to May, we saw bonds dropping off. This is the, of course, high yield bonds dropping off. Now, a big portion of that was because when we were rallying, We saw yields rally as well, which puts downward pressure on the bonds. But the bonds were falling off. They've slowed in recent days. If we take a comparison between the SPY and LQD, which is the corporate bonds, kind of like the quality investment ones, what you'll notice is it's been quite a few days here, really since the 28th of July, where LQD hasn't loved this move. It's not willing to take risk. Remember, yields have stayed relatively the same, so it's not like we can blame yields. The bond market is saying, I don't like this move. And trust me, I think the bond market is more correct than the stock market most of the time. It's strange and almost worrying that the bond market is not going with it. Now, things can change and they could become convinced by the Fed statement and go off in a nice, happy way. But at this stage, look at this. LQD is not coming with the stock market, and it's something that you should put on focus. Remember, it is important, at least during the beginning of the rally sessions. If we go over here to 2020, you can see what happened. The bond market came with the rally, dropped off a little bit, and then, of course, the market also went sideways during this time, and then it came with the rally. And then after that point, doesn't matter so much. But at the beginning, it should be coming strongly with any strong rally. It's not so much doing that at this stage. What's going on with the S&P 500 though? We said that we would bring up a whole bunch of charts. So let's begin by discussing the key level here. So we know that, of course, the 0.67 was a fairly important point on the chart. So if we go over here and we go 0.677 and we pop that on our chart, you'll see where it is. Wow. The 200 SMA, the 0.677, the downward trend line, the kind of right amount of time. What was it? 37. We're pretty much in that vicinity. The POC coming through. There's a lot of confluence at this point. If the bears really want to fight it, they probably should be fighting it here. There is another point moving forward, which is around 44.10 that a lot of people have as an interest zone. But if bears are going to make the stand, you would think they do so around here. How do we figure out, though, when the bears have some control in the market? Well, guess what? We've been discussing the same concept now probably for 200 points. And a lot of you are sick of it. You're like, Tom, stop talking about the possibility of a bear market. I will maintain, and I will still say this, that we have not seen one reason to actually go short yet from the price action. And this is the difference between someone that's cautious and looking for a reason potentially to get out and then just randomly shorting levels. You've got to be careful out there, guys. If you short, of course, options has been the better pick for that. The unfortunate thing is too many retail traders have chosen that option of doing it because they're scared of the stop loss. It's expensive, obviously, to do so. But what we've got here is a series of higher peaks and higher troughs the entire time. Now, is it extended? I think every indicator on the sun is probably saying and screaming, you've got to sell. That's what it's probably saying. But of course, people have been ripped up through this, unfortunately. We haven't seen the turn because we haven't even taken out one of these lows yet. Will we get one? Well, the critical points to be looking at are going to be over the next 24 hours, 42.77. A break underneath, a pullback a little bit, a potential sell-off. We've got 42.50. And then we've got the big one, 4200 and 4122. Make sure you load up your gaps as well. 4122.8 is around where there's a gap left by the CPI core inflation. I think if a pullback is to occur, this is a likely area for the market to target into. And it's around, if we go here, about 4% away. So we haven't seen one turn yet. This was a decent amount of consolidation. There's probably some orders here. The market goes underneath, pulls back a little bit, and then hopefully sells off. And if it's going to do it, it should do it here. And the reasons why are really everything. Trend line down, of course, the average over time. We have the take of the highs, the POC, the 200 SMA. There's a lot of reasons to hate this level if you're bullish. In fact, for me, it's probably the first time I'll say it. Yeah, I'll probably be looking for something in the next 24 hours in terms of these markets. But if it's not there, guess what? I got immense patience. So should everybody else. It is what it is. You can't know exactly what's going to go on. You're just stacking the odds in your favor. If the market goes through this level, so be it. You should always have some form of investment portfolio that's generally long, unless there's a real reason to be bearish on the markets longer term. And inflation is not one of those reasons. I've always said it here on the channel, and I never change my mind here. I believe that land is the deadly one. That's the one you've got to be careful of. If there's big issues in land, you've got to be careful. If you're interested in more stuff about that, you can always do our group mentoring. I teach it in that process. Let's go over here to the max pain over the Wednesday session. Well, guess what? You guys keep buying puts. I don't know what you're doing. There's puts everywhere. 425 now for max pain. That would be consistent with one of our key like little sup levels that we saw there before. So maybe we get down to 425 after the Fed's minutes or core retail sales. Here are where the big puts are. But it doesn't really get better moving forward. We've got the Friday, which is the interesting one, 407 here. So still quite low. It's creeping up, but that's a long way away from where the market is. But it's when you go deeper out. If we go over here into the 31st of August, 416, at least somebody's going bullish here. 445 calls opened en masse. We scroll into something like September. Let's go here to the 19th. I'll just check there where September would be. So we're looking September. The Friday will actually be the 16th. So we'll use the 16th one. And this, again, 408. So the big expirations with the big amount of puts, there's a lot of puts sitting on 400, which will probably be a huge blocker moving forward. We'll update you, but at this stage, there's puts everywhere, and you've just got to take it day by day and understand that when there are lots of puts, it's hard to short the market. It really is. It's when there's lots of calls that you should be starting to say, well, maybe I need to look for the reasons. And if you get them, so be it. Bitcoin looks absolutely crap. It's on the trend line. I just think it's trash. The reason why, and I'm sorry to Bitcoin people out there, I mean, can you really look at this chart and say that looks cool? It doesn't look cool. Let's move over to Ethereum. That looks a lot better. Ethereum has been, really nice base. We had the max pain concept. We've had nice swings on Ethereum. We've hit the 2000. Yeah, we've rejected it. If we keep selling off on the stock market, expect something like this level, which is around 1700 to 1750 on Ethereum. But it seems like most of the big traders or most of the good action has moved over to Ethereum. So that's the one to watch. We've been talking about it all video, so let's bring it up right now. Of course, core retail sales, 8:30 a.m., 1 hour before the market opens, New York time, guys. FOMC meeting minutes, that's coming out, and a whole bunch of annoying FOMC speakers coming out as well. Bowman, he won't bugger off. He comes out at before 9:30, and then he comes out at 2:20 as well. He just wants to talk. So he's ready. We've got the meetings ready at 2 p.m. and we'll probably find out by the end of Wednesday, maybe some form of actual direction on this market other than just bull into the sun. Yeah, we'll find out. Thanks so much for watching. Subscribe if you enjoyed the content. Give it a like. And remember, if you're interested in some of the things Tiger Brokers offers you, the community members out there, you can look at the link in the description down below and check them out. Thanks and bye.